Every trader has experienced the pain of cutting a winning trade too early, only to hold onto a devastating loser in the hope of breaking even. In this video, we uncover the hidden psychological engine behind these costly mistakes. Prospect theory and loss aversion. The Nobel Prize winning framework developed by Daniel Kahneman and Amos Tversky. By the end of this session, you will understand exactly how your brain sabotages your trades and how to apply institutional risk management rules to protect your capital. Picture this scenario: you enter a well-researched trade. Within 20 minutes, the price moves slightly in your favor, you're up $200. Suddenly, an intense wave of anxiety hits. Your heart beats faster and you think, what if the market reverses? I need to lock this green in right now. You smash the exit button, bank a tiny profit, and breathe a sigh of relief. 10 minutes later, that same stock explodes into a massive multi-thousand-dollar trend without you. Now rewind. On the very next trade, the price moves against you. You hit your predetermined stop-loss level. But instead of cutting it, you freeze. You tell yourself, it's just a temporary pullback. If I sell now, I make the loss real. Let me give it just a little more breathing room. You move your stop-loss down. The stock drops further. You start averaging down into a sinking position, hoping and praying just to get back to break-even. What causes this? It's not a lack of technical indicators, and it's not bad luck. You are caught in the grip of a deeply hardwired cognitive mechanism that has broken more trading accounts than any market crash in history. For over 2 centuries, classical economic models operated on a clean, comforting assumption known as expected utility theory. It claimed that human beings make decisions under risk like perfectly calibrated calculators, evaluating choices purely on mathematical probabilities and total net wealth. But anyone who has ever stared at a live order book knows markets are anything but strictly rational. In the late 1970s, 2 legendary cognitive psychologists, Daniel Kahneman and Amos Tversky, set out to test how real humans actually make decisions when real money is on the line. What they uncovered in their seminal 1979 paper completely dismantled classical financial assumptions. They proved that people do not evaluate risk based on their absolute wealth state. Instead, we evaluate choices through subjective, emotionally charged lenses of perceived gains and perceived losses relative to a moving mental reference point. This breakthrough was christened prospect theory. In 2002, Daniel Kahneman was awarded the Nobel Memorial Prize in Economic Sciences for this work, a historic recognition for a psychologist inside the field of economics. At the very heart of prospect theory lies the concept of loss aversion. Kahneman and Tversky summarized it in one foundational sentence: losses loom larger than gains. Through hundreds of controlled experiments, they calculated the mathematical asymmetry of human emotion. The psychological pain of losing $1,000 is approximately 2 to 2.5 times more intense than the joy of making that exact same $1,000. Take a look at the famous value function S-curve on your screen. Notice the steepness. In the green zone of gains, the curve flattens out quickly. Making your first $1,000 feels amazing, but making an additional $1,000 produces diminishing emotional satisfaction. But look at the red zone of losses. The line plunges off a cliff. Because your brain perceives negative outcomes so acutely, losing money triggers a primal threat response akin to physical danger. And that creates a dangerous psychological flip. Humans are risk-averse when protecting gains, but we become aggressively risk-seeking when trying to escape a loss. Let's translate this academic model directly to your trading screen. Loss aversion manifests through 4 specific destructive behaviors. Number 1, the disposition effect. Discovered by researchers Terence O'Dean and May Statman, this is the universal habit of selling winning stocks prematurely while holding losing positions far too long. Your brain wants to bank the psychological win quickly to feel good, while delaying the emotional pain of booking a loss. Number 2, mental anchoring. The exact price you bought a stock at becomes your psychological anchor. The market does not care where you entered. It only cares about present supply and demand. Yet traders evaluate every tick not based on where the asset is going, but whether it is above or below their personal buy price. Number 3. The break-even obsession. When a trade drops into the red, a trader's objective shifts from executing my system to I just want to get back to zero. You become willing to risk massive downside exposure just to avoid accepting a minor negative balance. Number 4. Revenge trading and gambler's tilt. When a series of losses occurs, the intolerable sting of being in the red triggers risk-seeking behavior. You size up, discard your trading plan, and take reckless bets to wipe out the loss in a single swing, frequently leading to account blow-ups. Here is the critical reality every serious investor must understand. Markets are structured around human psychology. When retail traders hold on to losing positions in denial, their losses eventually expand to a threshold where the emotional pain becomes completely unbearable. At that exact point of maximum panic, they capitulate and dump their shares at market price. Institutional algorithms and professional market makers understand this dynamic intimately. They look for these liquidation zones, areas where trapped loss-averse traders are forced to surrender their positions. If you don't master loss aversion, you will consistently be the liquidity provider for participants who have mastered their emotions. How do you rewire your brain to overcome millions of years of evolutionary bias? You implement a systematic risk management protocol that removes emotional discretion entirely. 1. Enforce hard bracket orders at entry. Never place a trade without simultaneously entering your stop-loss order in the market. Make the exit decision when you are calm and objective, before you have financial skin in the game. Once placed, never move a stop-loss backward. 2. Limit risk to 1% to 2% per trade. Loss aversion scales with position size. When you risk 10% of your account on a single idea, a drawdown triggers sheer panic. When you risk only 1%, the monetary loss remains below your emotional distress threshold, allowing you to execute cleanly. 3. Shift from dollar amounts to R multiples. Stop looking at the fluctuating dollar balance on your P&L screen during live market hours. Measure your trades in risk units or R. A loss is simply -1R, and a target is +3R. This depersonalizes the emotional weight of money. 4. Decouple process from outcome. A trade that followed your plan and hit a predetermined stop-loss is a successful trade. A trade where you broke rules, held a loser, and got lucky at break-even is a terrible trade that builds destructive habits. The most successful traders in the world do not avoid losses. They accept that losses are the inevitable, everyday cost of doing business, no different than rent for a retail shop or raw materials for a factory. When you neutralize the sting of a loss, the market loses its power to manipulate your decisions. You stop cutting your winners short, you stop tolerating runaway losers, and you allow your mathematical edge to compound over the long run. If you found real value in this breakdown, please smash the like button. It helps more traders find this content and beat the psychological traps of the market. Make sure to hit that subscribe button and click the notification bell so you never miss our deep dives into trading psychology, risk management, and market strategy. Drop a comment below with your biggest psychological hurdle when handling losing trades. Thank you for watching, stay disciplined, and we will see you in the next video.